So on Thursday, it was the DXY index that soared because of the euro falling quickly. And then on Friday, I don't think many people noticed, China's yuan fell very sharply. In fact, CNY, the onshore rate, fell below 732 to the US dollar. The offshore rate fell even further. What we're really talking about here is China's yuan, the rising dollar, focusing on China because the banking system, that's what's different this time around versus say a couple years ago when China's yuan was weak that back then. For its entire history, especially the modern history, everybody's been predicting the demise of China. And the reason why there hasn't been such a demise of China is because the banking system has been able to maintain and to be able to carry out what Chinese authorities are hoping that they can do to keep the economy at least moving in the right direction. But all that changed in 2024, which introduces a number of different risks, and not just in terms of financial risks, but also in the real economy. And from Xi Jinping's perspective, from the CCP and the political situation. I'm not saying that, again, I'm not predicting China's demise. We're not saying that China's collapsing before our eyes. As Brent Johnson and I were talking about with the DXY index yesterday in the live video that we did here in Colombia, again, thanks to George Gammon, we're not saying that China's going to collapse, but it's going through a phase transition, which can end up being messy. And so the falling currency in whether it's China's yuan or the euro or Brazil's real, China in particular, what it's doing, the dollar, as I said with Brent, it's shining a spotlight on these weaknesses in China, and really with additional emphasis on the fact that there's something different about the banking system. Now we have a decent idea of what that is, but we don't have a good idea of how big of a problem that is. And that's what we'll talk about in the third part of this video, this live stream here, is authorities there are, they're not going to say they're panicking right now, but they're definitely scrambling because they know that there's a big problem in the banking system on top of everything else that's happening in China. So I think the thing that we want to start with is what's happening with the currency. Let's straight up everything. Authorities, ever since the middle part of November, they've been trying to, as they often do, set the midpoint relatively high compared to where the actual exchange value is. In this case, the onshore rate, or CNY. So ever since the middle part of November, they've been fixing the midpoint at around 720 to the US dollar, even as the currency itself kept moving further and further towards 730. That was just authorities' way of saying we would prefer the currency not go lower. They're sending signals to the marketplace. They're sending signals to speculators. We don't want the currency to go down to 730 or, God forbid, something less than that. They're trying to say we would prefer CNY to be around 720. That's really all it is. This midpoint parity is really a signal and nothing else. But the fact that they've maintained that signal ever since, we're talking about 2 months here, emphasizes how much they don't want the currency to go a lot lower. And then over the last couple weeks or so, they have been soft pegging the currency to 730. So I circled the midpoint parity, which is, the signal we don't want it to go really lower than 720. It goes much lower than 720. And then over the last week, it's very clear intervention in the marketplace. You see a very narrow range in the currency exchange value, which is telltale sign that authorities, probably not on their own, they're making Chinese banks act on their behest to intervene in the currency markets. So you saw the CNY, the onshore rate, the exchange value stuck at just right below 730. It couldn't have been more obvious if they tried. So they would prefer it at 720. They intervened at 730. And then after we had the euro drop sharply on Thursday, yesterday, Friday, CNY finally broke down below 730, and it fell all the way to 732 to the US dollar. So big drop in the onshore rate. And it was also the weakest onshore rate going back to September of 2023. And it was led in large part by the offshore yuan rate, which fell sharply all the way down to some parts of yesterday. It was down as low as 737, finishing up around 736, which is, almost a, multi-decade low here, or more than decade low, matching September of 2023. So you see the sharp drop in the yuan, like you've seen the sharp drop in other currencies around the world. So the dollar going higher against specifically China's currency. And it's just highlighting the fact that risks, not just the economic situation, But in this case, financial risks are rising. Of course, we've seen that onshore in China's government bond market. Bond yields have just absolutely crashed. And of course, the mainstream media will talk about falling bond yields in the context of, well, that's just the market pricing in additional stimulus from the PBOC. And even if you believe that, even if you believe the market was pricing interest rate policies from the PBOC, you still have to ask yourself the question, why would the PBOC aggressively lower rates anyway? It all adds up to the same thing. But again, like the Western central banks, the central bank in China is merely following what the market has been doing. And the market has been rallying there since now it's 2025, December of 2023. Massive rally in Chinese bonds over and above any rate cuts by the PBOC or even what they're talking about, as I'll get to at the end of this video. Lower growth and inflation expectations, higher degree of demand for safety and liquidity, which goes along with not just a malfunctioning economy, but what is really going on in China's banking system. We'll see how different it is in 2024 versus previous years. And that's, we had a big flight to safety in the 1-year Chinese treasury in December. The bond market in China ended last year with a record low in the 10-year maturity, a record low in the 5-year maturity, a record low in the 2-year maturity. So the bond market is not buying anything other than safety and liquidity. And it's made a very big move, as I said in the video that came out also this week. November 27th, that period of time comes back. I talked about in the video that there's a possibility the market is looking at the Trump imposition of tariffs on China as another negative that this fragile Chinese system just cannot handle. So a big downdraft in Chinese interest rates, and especially the 1-year maturity, which just absolutely crashed in the middle of December up until the week of Christmas here in the West. It fell almost, I think it was 50 basis points down to around 85 basis points in yield by December 24th. It retraced a little bit, got back above 1%, but then ended the year and started this year going lower again. And as of this week, as of yesterday, China's 1-year, not quite at a record low like the 2 years, but it's back down to around basically the same rate of 1%, which means the flight to safety didn't end at the end of December. We're still seeing a dramatic flight to safety or demand for safety and liquidity in Chinese government bonds. And so like everything else, you have to ask what changed, not just after November, but in the middle of December as well. And I talked about that in the video where there was reports that Chinese government officials were sending out notices and asking for more information about various financial participants and their exposure to China Vanke and another Hong Kong developer. So that's flaring up all over again. And there's also some signs of liquidity pressures, which I'll get to in just a moment. On the other side of this, the good news in the economy, at least some partial good news in the economy. Last weekend, the authorities there, they said they published the results of their December PMIs, and the non-manufacturing, the services sector PMI actually jumped by about 2 points, which finally suggested that maybe, just maybe, there was some response from the bazooka, because the services side of the Chinese economy has been incredibly weak. Forget the stimulus, forget before the stimulus, even before the stimulus was announced, and the constant stimulus going back to really reopening in 2022. The services side of China's economy has been the weakest link there. So there were some positives in the fact that the PMI finally jumped up to around 52, a little bit higher than 52. Though that wasn't expected. We've been expecting some response from the bazooka. And in the context of, is that all? And it took a couple of months to get there. You can see where China's bond market is not buying that this is the start of a recovery in China, or this is the beginning of the Chinese economy stabilizing. This is just more noise and more variation and volatility in, another one of the economic accounts in China. You see the long run trend, even rising to 52, it's not really all that good. Which goes to show how weak the Chinese economy, especially the services side, has been all along. The manufacturing that went in the opposite direction, which I think grabbed more attention in the marketplace than the services PMI did, because you would think that given all the bazooka stimulus and the attempt to really ramp up production and dump all that stuff on the rest of the world. Everything that we talked about with China's industrial profits that absolutely have crashed since August, that's really what we're seeing in the manufacturing PMIs that never really rebounded all that much. Now moving lower in December, that's not a good sign. And that was corroborated by Caixin's private manufacturing PMI, which also fell by a full point in December, suggesting that, again, for all the hype over the bazookas in September, there's really not anything to show for it. You got 1 2 point pop in the non-manufacturing for December. Manufacturing was up a little bit, then rolled back down. So the bazookas are, from a economic and macroeconomic perspective, they're already not really producing many results. But the real issue here, it's really about the banking system. Whenever China has gotten itself into economic trouble, Xi Jinping and the CCP have been able to direct the banking system to help get them out, or at least to stabilize the economy before it really got to what everybody had feared back in 2016, for example, the real hard landing in China. Every time there was supposed to be a hard landing, every time, Western media and everyone else predict that China's demise and everything, they were gonna finally suffer the full consequences of many, many years of distortions. The banking system would always be there to crank out whatever credit was needed to stabilize the economy, but really to just pump more credit into the real estate bubble as the engine to try to stabilize the economy. But the banking system was always there. And so what's really different this time, really starting last year, is that banks are not there this time. So we have to ask the question that the markets are asking: is this time actually different? And again, I don't mean China's collapsing, the economy is going to crash or anything like that, but the paradigm shift where this can get really messy between coming from where China was even just a couple of years ago in the 2020s, 2021, 2022, to where maybe they're going, and they don't really want to go there that quickly. So China's banks, and I've shown the data on the Chinese banking system all along, and I've been saying for the last couple of years, really since reopening, there's a big problem in the Chinese banking system. You can see it in the credit stats. The outstanding stock of RMB loans has the growth rate. They're still growing, but the growth rate has really accelerated downward to another. It's record low after record low every single month, suggesting that the banking system they're extending more loans, but doing so only to the best customers, which are the most safe and liquid, which are state-owned entities mostly. So the private Chinese system is being starved with credit because of this growing risk aversion that is in part driven by macroeconomic problems, but also the real estate problems too. Because unspoken in all of this credit data, the fact that Chinese banks are really not extending a whole lot of credit, the unspoken part of that is that there has to be a degree of credit losses, really a credit crisis that we can't see in any of the numbers, and nor would we expect the Chinese Communist Party to come clean about just how many bad loans there are on the books of all these Chinese banks. Officially, it's not that big of a deal, but we know just from the behavior of the banking system, unofficially, it must be a big deal. And again, this is what's different this year versus previous years. Um, Even though the authorities in China they very much want the banking system to extend credit and to help stabilize the economy. Really, since 2022, banks have been doing the exact opposite. And you don't see that normally. You don't see the banking system or any business or any industry defy the Chinese government. So the fact that the Chinese banking system has been able to get away with this, despite the fact that the authorities want them to do something else, also suggests very strongly that there is something preventing banks. It's not a choice. They're not saying, Xi Jinping, we'd rather not do this. They're basically telling the government, we cannot do this. And I think the best chart that puts all of this together is the cumulative total social financing in terms of RMB loans. This is just year to date through November. It's the latest data that we have. We'll get the December figures and therefore the full figures a couple weeks from now, later this month. But you can see big shift in the Chinese banking system extending RMB loans in 2024. That's where everything changed. And that's where you started to see the big drop in interest rates and more weakness in China's currency. The currency has been very volatile, and it also had some periods of strength, like when it was piggybacking off the yen carry trade into August and parts of September. But ever since then, it's been sinking like a stone again. And as I went over in the beginning of the video, the Chinese authorities would rather the CNY level off around 720, and then they intervened at 730, and now here we are sitting at 732, and the offshore rate going down further, which is all of these things are related to the same thing, which is something is going on in the banking system. But that's something so far is really just more about credit problems, credit crisis, bad loans that are piling up on Chinese bank balance sheets. What we don't see just yet, though we might, I'll get to that in a second here. What we don't see yet is that credit crisis becoming a full blown liquidity crisis. And therefore, as you hear sometimes, China's version of 2008. We don't see any concrete signs of that, but there are a couple things that we need to pay attention to as far as liquidity goes. There was a couple spikes up in China's repo rates, which is a key important rate when you're looking at and you're monitoring liquidity in the Chinese banking system. But these are quarter end, year end spikes, not necessarily unusual. And you can see previous, going back to 2023, there's much more volatility in the repo market. So not anything here that suggests that there is an outbreak of liquidity crisis, that those types of proportions. But there is enough that suggests it's not necessarily moving along and functioning as smoothly as Chinese authorities would like. So again, not liquidity crisis, but irregularity might be the best way to put it. So repo rates, they've been falling. Some of that is because of the Chinese central bank, the PBOC, has been cutting the 7-day repo rate, which they now use the 7-day repo rate as their main monetary policy or interest rate policy rate, rather than the MLF rate, which they still use to an extent, but they're no longer emphasizing the medium-term lending facility or MLF. Instead, they're relying on the 7-day repo rate because they're trying to make the PBOC more like the Federal Reserve and ECB, which is already a clue that things are not going well in China either. So the repo rates are slightly elevated, especially at term. The term repo rate, the 7-day rate versus the overnight rate, which is not necessarily unusual either, but it does suggest that there is some additional spread for obviously 7 days that the Chinese banks are requiring to engage in repo transactions. And that, again, we saw that back in 2023, but back in 2023, things were irregular there too. So there are some initial indications that on top of the banking crisis, the credit crisis that's going on, there has to be a crisis, because that's nothing would get the Chinese authorities to start scrambling around in the way that they are if there wasn't one. So we know there's irregularities in the banking system. We start to see the return of some irregularities in the repo market, which means cash circulation. So it's at least enough to focus on and monitor moving forward, because given the way things have evolved in the banking system, as well as the real economy that's not really responding to the bazooka, as well as why authorities are scrambling as they seem to be doing, we need to take this seriously, as seriously as the U.S. dollar exchange value is, or the U.S. dollars, the dollar versus the yuan is doing right now. So last month, as repo rates were rising, the PBOC used the medium-term lending facility after trying to downplay that all year in this whole reform agenda. They injected a ton of cash in using the MLF. In fact, it was a record amount for any month. And they also started to buy bonds to inject reserves into the system by buying bonds, the same way that the Federal Reserve does whenever it feels like it. The temporary open market operation. We're not talking about QE. The temporary open market operations to make sure that there's enough bank reserves in the system so that you don't see a sharp spike in repo rates. So what I'm saying is that the liquidity irregularity to go along with the banking problems and the macroeconomic circumstances, the Chinese authorities' response to that is as eye-opening as everything else that we're seeing. Again, it's not the end of the world. It's not a massive crisis, but it does demonstrate that authorities are taking this seriously enough that they felt that they needed to make a major infusion of cash through the repo market to just calm interest rates down as much as they possibly could. And they also have been reiterating the fact that they're going to cut rates at some point in the future. They keep saying at an appropriate time. What they're really saying is, yeah, we know that the stimulus plans that we've been implementing, mostly through lower interest rates, haven't really paid off. So we're just here to remind you that whenever we need to, whenever we think the situation calls for it, we're going to continue to lower interest rates as we feel it's necessary. So on the one hand, what they're trying to do is say that they're holding their powder dry in case the trade wars become a bigger problem than they're hoping right now, as well as they're also trying to say that, well, this is not necessarily a big deal in the economy. We're confident enough that we'll see how things play out in the macroeconomic situation. as well as we're not really going to panic. We're not going to appear to be panicking over the banking situation either. But they are making major moves. They just didn't want to lower interest rates because it appears they thought that would send the wrong signal, which is basically the policy that they've been following for the last couple of years. Not that it has worked, but basically trying to pretend and trying to play it off as not that big of a deal. Meanwhile, doing things bigger and bigger and bigger things because they know they have to do something. And it all goes back to that main point that I said at the very beginning. So CNY is falling, and it's falling sharply to start 2025 as the US dollar exchange value is rising against a whole bunch of other currencies because things are not going in the right direction. And as Brent and I were talking about in yesterday's video, the US dollar goes up, it tends to highlight the weakest parts of the global system. And right now that's China. It's also Europe, but that right now that's China. That's a big one. Ended Friday with a large drop in especially the offshore rate, which is where a lot of tension from officials had been this entire time. And that's what's really different in 2024 and now 2025 compared to previous times. So every time that China got itself into a mess, the government would tell the banking system that you need to extend credit to here, here, and here to get us out of this mess. We're going to do the old Keynesian stuff where banks are going to fund whatever government priorities there are, no matter how wasteful and unproductive they are. We don't care because the Chinese banks had always been able to make enough of a return that whatever bad loans were generated doing these things, there was enough of a return to absorb those bad loans and not turn Chinese banking system and their balance sheets into a complete nightmare and mess. That's where we get into 23 and 24, the transition there, where the banking system may have hit a wall, both theoretically and in practice, where they can no longer extend credit. That process is no longer happening, which means that every time that the authorities in Beijing have been serious about trying to rescue the situation in China, being able to depend upon the banks was always their last resort. It was always the one thing that could get them out of trouble. And as we saw in those really, really sobering statistics on the bank lending, the banks aren't there this time. And the markets know this. That's why Chinese bond yields are moving so much lower. Authorities know this, which is why we continue to see them scramble, even though just, September, the mainstream media, certainly in the West, was going crazy over the bazooka, how Chinese authorities got it this time. They're not fooling around. They're going to put in all of the measures that are going to be required to make sure that the real estate sector stabilizes, the economy stabilizes, and everything else will be fine. And then they slipped in there during their bazooka press conference in September with the PBOC officials and the head of the bank regulators. They slipped in there. Oh, by the way, we're going to recapitalize the banking system. We're going to spend about $1 trillion to do so. And we haven't heard a peep since then, which is should have everyone's alarms raised, because first of all, why did they announce it and then not do anything about it? And then everything that we've seen since then just reinforces the notion that at the very least, China has a credit crisis on its hands in the banking system, and authorities know it, and so do the markets. So we start out 2025 with all of those things happening, and all of those things still happening, and a whole lot more questions. And we're not talking about China collapsing. We're not necessarily saying that the credit crisis is becoming a liquidity crisis, but there are enough concerns that is a non-trivial possibility that it explains exactly what we're talking about here. So thank you very much, everyone, for joining me again. Thanks to George Gammon down here in Columbia, Rebel Capitalist HQ. See you all again on regular schedule on Monday.